We welcome everyone and thank you for joining us. It's really a pleasure to have Rudy with us, who's the founder and CIO at Lyptus Capital. Rudy brings about 2 decades of experience in global investment management and strategy. He spent about 15 years at Fidelity Investments, where he served as deputy portfolio manager for International Capital Appreciation Fund, delivering top decile returns and managing an AUM upwards of $15 billion. He's also an alumnus of Harvard Business School, where he earned his MBA. So Rudy, over to you. If you can, take us through the fund, the Lyptus fund, the philosophy of the fund, and your perspective on also some of the big questions, the burning questions that a lot of investors are asking right now. So, for instance, is AI in a bubble, or is it just a long-term story which is just starting off? Another key question is, are US markets overvalued? What are the key risks that you are currently perceiving? And how is your portfolio poised to navigate the risks? So I'll just hand it over to you to take us through the fund.
Sure. Happy to do that. So if you could just go to the next slide, I'll just take you through some key slides, and we can just focus the discussion on the Q&A. So if you could just move down to slide 4. So I'll just quickly take you through, the key points. So I think moving to the next page, the most important thing to understand is why one needs to invest globally. Now, most of you are outside of India, so this point will not be lost on you on why you should invest outside your home market. So we can skip this slide. I'll just take this as read because I think most people understand why having globally diversified equities is important. I just want to start with this page, which is just a level setter to tell you that over the long term, over 10, 20, 30 years, the total stock market return over long periods of time have been anywhere between like 9 to 10% over long periods of time. And the chart on the right tells you that if you invest in India, you can add 4% every year because the rupee typically tends to depreciate by that much every year. So if you look at the All Country World Index, it gives you a 9% dollar return. If you're an Indian investor, you add 4% for rupee depreciation, a couple of percent of excess returns over the benchmark, which you hope to generate over any 5-year period. And you get to a 15% kind of rupee return, which is very attractive. The Indian market's given you that 15% of the time in history. So I would say that that's the kind of return expectation one should have looking at history. Obviously, if you're not in India, if you're located overseas, the rupee depreciation doesn't impact you. But when you compare investments with global to India, you must adjust for the rupee depreciation because when you look at returns in rupees, it's artificially boosted by the rupee depreciation. You should convert everything into dollars to look at it. Moving to the next slide, why invest in a global fund as opposed to country funds? What this chart shows you is over the last 32 years, global funds led by the US has done the best. So this is just the equity benchmark of all globally listed equities. The red line is India, the yellow line is emerging markets and IFA. So what you see is over long periods of time, if you just own a global fund heavily weighted towards the US, in this case 65%, and you just buy the index, you don't do anything fancy, you do really well, and India does the second best. But if you look at it over any 5-year rolling period on the right-hand side chart, it just shows you that the only two markets you need to invest in are basically India and the world, led by the US. So on any 5-year rolling basis, these have been the two best performing markets over long periods of time. You don't need to invest in emerging markets and in Europe and stuff like that. That's what the analysis tells you. So I think if you have a starting expectation of a high single digit dollar return, I think that would be a very good return. I think the last 5 and 10 years have been very exceptional. I don't think they repeat for reasons we can get into, but that's the way I would think about it. So moving on to a couple of more slides. If you could just move on, I can just walk you through our investment philosophy and process. So I think this slide basically tells you that if you look at the world, it's always led by technology. First, it was PCs, then it was mobiles, it was data, the digitization of everything. And now you have these new trends like AI, high performance computing, data centers, and you don't get access to this in one place. You could always buy a tech heavy fund, but it's also very volatile. So you need to be comfortable in years like 2022 when you get a drawdown of 35%. People normally get scared and sell at the wrong time. But I think better than doing that, if it's the first or second global investment you're making, just be very well globally diversified. That's the right way to go. So our fund is heavily exposed to these trends like AI, and I can take you through why I'm quite positive on it. Moving to the next page, I think what this, we can skip the team details, given I think Raki's done a very good job of giving the background of us. I'll stick to this slide, which is basically trying to explain that we invest in 20 to 30 blue chip companies globally. They typically have a market cap greater than 10 billion, very high quality. They're very different versus the benchmark, which is the index. So we have at least a 70% active share, which basically means that if you see names that are very familiar, we're much more positive on them and have a higher active share, and we're looking to beat the market over long periods of time. Moving to the next slide, without getting into too many technical details, a lot of people ask, how do you pick these 30 companies? So we've basically been with this large fund house called Fidelity for the better part of 20 years. We figured out what works, what doesn't. And we've identified 80 companies worth owning over any period of time. 30 of them make sense to add to the portfolio. They have one of three characteristics. They have barriers to entry, they have the best in class in what they do, and they have brands. Now, these sound like catchwords. How does this translate into actual financials? What you see is at the portfolio level, we have anywhere between an 18 to 20% free cash flow margin and 18 to 20% return on invested capital at the portfolio level. So these are very, very high quality companies. They tend to grow by around 10% in US dollars over any 3 to 5 year rolling period. So what we're trying to do is just pick stocks that can keep compounding 10%. If you get a 10% return in US dollars, that's a very, very good return. And obviously, we try and aspire for a little bit beyond that. So that's how we pick these 30 stocks. We're divided by sectors. My teammates have spent 17 years and 12 years at Fidelity, respectively. We don't kind of look at all 2,000 stocks in the universe and try and pick which are the best stocks. We know which are the best 80 stocks. So our focus really lies in picking the best 30 among them. Moving to the next slide. So this is how our portfolio is constructed. We have 30 names. Each of them have an active weight. So if Nvidia is 5% of the benchmark, we can own 8%. If another stock is 2% of the benchmark, we can own up to 5%. So we basically buy the 30 best stocks, equal weight them on an active basis. No country or sector is plus or minus 15%. And we're just buying, think of it as buying the best 30 companies in the world that make sense from a valuation and return perspective. Moving to the next slide. This basically just shows you how dominant our companies are. So if you look at the top companies we own, they have almost a 40 to 97% market share in what they do, which means they have a lot of pricing power. They're well established, well entrenched companies with deep moats with the ability to grow. And we just think, like, rather than reinvent the wheel, understand which are the best businesses in the world and own it. And we don't own a lot of large businesses. Like, we don't own a stock like Tesla, we don't own Apple, we don't own Google because they don't fit our valuation framework, right? So you want to buy great companies, trading at reasonable valuations with good growth prospects. But if you get the valuations wrong, it doesn't matter how good the companies are. But at the same time, if you don't buy companies with deep entrenched market shares, you're not going to make money. Moving to the next slide. This chart basically shows you that what we aspire to do is buy companies with relatively stable market shares on a relative basis, and we want stability. So we don't want companies that can grow from 5 to 20% market share overnight because that could fall to 5% the day after. We're looking for companies with very, very consistent and large market shares, the ability to have pricing power, pass it down to non people in the non-financial sector. But what's very important to realize to make money in the market is just have an understanding of how much money you make over long periods of time. That answer is like 9%. If you beat the benchmark, you can make a little bit more. If you invest in India, if you're comparing it to rupee return, you got to adjust for the rupee depreciation and add that to your dollar return to compare it to a rupee return. And the long and short of this is I've put a significant amount of my capital into the fund because I believe in eating my own cooking. If you were to ask me what are the things to be wary about, I think Raki mentioned a couple of things. One is this AI. People think it's long in the tooth, but I would say that we're probably in the second or third innings of this infrastructure build out. The large companies in the world have spent, the top five companies have spent $400 billion of capex this year. I think that goes up to almost 900 billion over the next 5 years. So this is, and people think that no money is being made on AI because they haven't seen the face of it. But if you look at companies like Meta and even Google, they're making a lot of money by targeting advertisers better. And of course, there's a lot of expenditure that's wasteful, and people will get burnt. But if your companies are making high returns on invested capital from their investments, like our companies like Microsoft and Meta and stuff like that, we're very happy. So I'll just end by giving you a flavor of the 30 companies we own. If you could just flip to the next slide or two, this lays out, maybe just slip. Yeah. So if you see this chart, this is a chart worth spending time on. The right-hand side chart shows you that on a relative basis, we're very attractive versus the market. So the markets are a little bit expensive versus history. So typically the market discounts something like 17 years worth of earnings or 16 years worth of earnings. Now it's doing close to 19. So are you high relative to history? Yes. Maybe 2026 is being discounted today. But if you have a 3 to 5 year view on a relative basis, we're very attractive. So what the right hand side chart is showing you is versus the market, we're only 40% more expensive, but we have twice the return on invested capital, twice the EPS growth, twice the free cash flow margin. So this is like a very attractive entry point on a relative basis versus the market. So moving to the next slide, this chart just shows you the summary of the 30 stocks we own. I think this is the most important slide, which is know what you own. A lot of these companies you will recognize, but just think of these companies having very dominant market shares in their respective segments, run by extremely good management teams with extremely good growth prospects in front of them, uh, that have been around for like 20, 30, 40, 50 years, in some cases a century, and that we think are going to be around for a long time and make a lot of money. And we're paying a reasonable multiple for this. We've broadly broken it down into six buckets. They're pretty self-explanatory, so I won't go through them. But basically, what you're looking to buy is, if someone just told you just what are the best 30 companies in the world, give me 30 stock tips. This is what the 30 companies are. But someone's actively managing this on a day-to-day basis, trimming some, adding some, and doing it. So typically, if you find large funds, they invest in 100, 200, 300 names, rely on centralized research. We kind of have a different mousetrap, but that's in essence what we do. So we can keep this conversational. I think what's most useful in these sessions is I just speak for 15 minutes like I have, and then we just open it up to Q&A, right? Just answer your questions and see if I can be useful or helpful to you, and just tell you what the risks are. So Rocky, over to you.
Thank you. Thank you so much, Rudy. That was really very succinct and helpful. If anyone has any questions, you can either post it in the Q&A button or raise your hand and ask directly. Meanwhile, let me start with the first question. I think, Rudy, you mentioned that, there's a lot of capex that is getting spent on AI, up to 400 to 900 billion. Like this kind of capex is unprecedented. And also there has been a lot of talk of circular funding in AI, where big tech companies are investing in AI startups. Those startups in turn are, spending heavily on these big tech infrastructure, and there's a lot of circular funding going around. And while there may be some companies which are earning revenue, I think it's not really translated into any sizable revenue or even profits for a lot of these companies. So how do you see this whole dynamic playing out? What are the risks? What are the opportunities? Some people also talk about a second from the dot-com. It kind of reminds people of the dot-com burst that happened in 2001. So, what's different this time?
I think Sudhir will share with you and participants. In my last monthly update, I addressed exactly these five issues. So I've actually written a note on it. For those who are interested, you can see it. But the summary of it is five things. One is, at the peak of the 99 bubble, the index was trading on some 70 times earnings or 60 times earnings. Today, you're at 25 times. That's point number one. Point number two, last time you had a lot of loss-making companies that were going up. This time, all of them are equity finance. They're profitable. So that's what's different this time. The third difference is people think that no one's making money from AI. But if you look at a company like Meta, they've increased their capex almost 60, 80%, and their revenues and profits and margins have gone up. So they're basically using AI to better target ads, and the ROI is actually quite real. So I would say that a lot of people, like these young startups that are burning money, I don't know where they land up. And those guys will face their reckoning if they don't find a business model. But I think all this stuff on circuit financing and all is not relevant for my companies to a large extent, because these are large, they're very well diversified in terms of their revenue base. The only one large company that a lot of these guys are making money off is a company like OpenAI, right? That's the one company where a lot of these large companies do business with, and you need to believe that they will keep getting funding to do these deals with them. But with the exception of that company, most of the other companies are very well entrenched. Like Google, who are the big spenders? Microsoft, Google, Meta. Like they all are spending 400 billion. But what nobody's talking about is how much cash flow from operations they generate. They generate $650 billion of cash flow. So if you look at the free cash flow they're left with after paying off this 400 billion, they're left with $250 billion. So this is not debt finance and not equity finance. And what's the worst case? They stop spending and then the returns go up, right? So I would say that for the large companies, it's not so much of a risk. But yes, for smaller companies, VC fund, there's a lot of hype over there. If you don't have a business model with AI, you're going to be in deep trouble.
Fair enough. Fair enough. I think the other question is also around the dollar and de-dollarization trends that we are seeing. You mentioned about the rupee depreciating against the dollar, but early this year we also saw the dollar depreciate against the euro and so on. And there's a lot of talk of increasing de-dollarization, and many emerging markets exploring trade settlements outside the dollar. Yet the dollar remains a key currency. 60% of the global reserves remain in dollar. It dominates international trade. There is no clear alternative in sight, but still, there are trends which are also suggesting that the dollar might depreciate even more. So, what is your view on the direction of the US dollar over the next 3, 4, 5 years, given these pressures and talks of de-dollarization?
So I think, Rafi, you very well articulated my answer, which is the same as yours, which is there's no alternative. 60% of trade happens from the US. All this is good talk and good newspaper reporting, but in reality, nothing's going to change. If you're looking for a trend, I would look up this index called the DXY. It's called the dollar index, and look at it over the last 30 years. It's ranged between 90 to 110 quite consistently. You're currently closer to 98. So can the dollar depreciate by 10%? Sure, it can. But it follows a cycle, right? And that cycle is very hard to predict. I would not call the end to the dollar. And the reason I wouldn't do that, a lot of people talk about the large US fiscal deficits and stuff, but you go back to Warren Buffett's article 32 years ago, he was talking about the same thing. It's a Fortune article. If you Google Warren Buffett Fortune article, US deficit, you can read that article. And we're talking about the same stuff today. I think obviously Warren's a very smart person, but I think what people miss is that technology is extremely deflationary. So you can keep printing money to fund your fisc, but what you ultimately see in reality is something different, which is human automation. All that keeps happening. So the inflation never comes basically. So I'm not too worried. Obviously, the US has problems, but betting against the US has been a bad idea for the last 250 years. And I think for the next 5, 10 years, it's a bad idea to bet against the US. I won't worry about all this. Talking about topics like dollar, the demise of the dollar and all is on a lighter note, a little bit like listening to Shashi Tharoor. It sounds very good, it sounds very articulate, but you don't come up with a definitive conclusion on what the guy is saying at the end of it. So I think these kinds of topics are worth tracking, but look at long-term history, look at the chart, and just understand that it trades within a range. There's no alternative. Also, the point I'd leave you with on fiscal deficits and stuff like that is the two best performing countries in the world have been the US and India over the last 30 years. What both countries share in common is they both share a twin deficit, a current account deficit and a fiscal deficit. And the reason why normally this is a bad thing, but the reason why it's a good thing is the market imposes that discipline on you. The moment you try acting funny, you try spending more than you earn, the dollar depreciates, the market hits you, and you behave. So actually think that it's a good disciplinary mechanism. Whereas places like China, places like Turkey, places like Brazil, they make surpluses in one area and they just profligate and they make a lot of mistakes. So I actually see the weaknesses actually as a positive.
Got it. So you think technology being a deflationary impact, US will still come out positive from the fiscal deficit?
Correct. Yeah, that it's not going to be a problem. The deficit will keep rising, right? Japan's at 200%. The US is 135%. So it'll just keep rising, but technology will ensure there's no inflation and you'll continue to make good money. The most important thing to realize with global investing is all this GDP and fiscal deficit, ultimately what drives earnings driver of the market. And all these top companies are generating dollars of cash flow and they're growing. So if you compare to these Indian companies or the Middle Eastern companies or any companies in the world, they just don't grow earnings as fast, despite their GDP growing much faster. Because all these businesses have done maramari and they've consolidated, right? Google and Meta account for like 80% of spend. NVIDIA has 90% market share, leading in GPUs. TSMC has 95% market share in leading edge. ASML has 7% market share in making EUV lithography machines. Cadence and Synopsys are a duopoly. Broadcom is a Dada and ASICs. They're the largest players. So you combine all this, it's like you have pricing power and you have growth. And that's why these companies do well. What we need to do is make sure expectations get met, because if they don't, you'll do badly and you need to pay the right multiple for it. It's as simple as that.
Got it. It's actually a good segue into the next question from one of our viewers. And the question is, what is your take on the current valuations of some of these companies in your basket, which are at 30 plus? And is it still a good time for us to enter this basket for someone who does not have exposure to this particular segment? Is it still a good time to enter?
So no, you never ask a barber if you need a haircut, because the answer will always be yes. So I would
Okay.
just say 30 times means nothing if you don't compare it to the return on invested capital of the business and what the earnings growth of these businesses are. So let's go line by line. ASML is on 29 times, 28 times forward earnings, but the earnings on a 3-year CAGR will grow double digit. Nvidia is on 30 times, but they're growing in 30% from a very high base. TSMC trades on 20 times earnings and they're growing earnings 15% every year. They'll double in the next 5 years. Cadence is expensive, Broadcom's expensive, but they all are trading, growing very quickly. So if you're, I don't own Apple because they trade on 30 times earnings and they will grow earnings 8%. That doesn't excite me. I don't own Tesla because they're at a 1 trillion market cap. They have a market cap greater than all car companies combined. Do they have a moat? Yes. Are they good? Yes. But are they better than all the other car companies combined in terms of their technology and their relative advantage? No. So you have to pick. See, the one thing I've learned in the markets is 30 times earnings can sometimes be cheaper than 10 times earnings. And why do I say that? Because the 10 times is earning because the earnings are going to come down or they have leverage issues. But the 30 times, if they keep compounding, will become 15 times and you can do really well over long periods of time. So I would say always look at the multiple relative to the earnings growth. And I think this basket of companies have that good mix.
Oh, one more question is around asset allocation, and I think you spoke about it, especially for resident Indians who have a significant exposure to domestic equity. It makes sense to have some exposure to global markets as well, because one is, of course, the currency depreciation, and the other also getting exposure to some of these key sectors which are not there in India. So, Rudy, according to you, what kind of allocation should investors typically aim for between Indian equity and global equity? From a long-term perspective.
So 1% of Indians have global equity exposure. If you look globally on their international market, 30% of their exposure is international. If you look at the average of US, international stuff like that. So I would say if I'm sitting in India, I would say at least 30%. And
And
also
why?
one thing is return. The other thing is safety of having the money abroad, right? Like supposing your kids want to study abroad and supposing they like it there and they want to live there. Like you can't buy a house for them if you want to replicate your lifestyle. So having the dollar assets abroad is very useful. And obviously you want it to compound without hurting your returns, which I've shown you over 32 years. Global stocks have done quite well. So it's not only the return, but it's also the security of having that in case you want it, because India has LRS limits where you can't take certain amount of money out of the country every year.
I
So
think
if your
one more
question is
question
why
is,
30, why not 50, why not 10?
yeah,
That's just based on what I think makes a lot of sense. So 70-30 is high because India has the next 5 years ahead of them, which is good. But if you ask me, like at these valuations, I think global makes on a relative basis, although global and India both are expensive, global looks way more attractive to me.
got it. The other question is also around role of gold and silver in the portfolio. Gold has done really well in recent years, especially this year, driven by central bank purchases and also geopolitical certainty, which is not going anywhere. It's staying, and silver again has a lot of interest, both precious and as an industrial metal as well. So how do you see the role of gold and silver in a diversified portfolio today?
I would say historically it's worked. It's hard to argue against it. What the future will hold, I don't know. So I'll just fully disclose I don't own gold. And the reason why I don't own it is my strength is to figure out what the discount the future free cash flow of a company and say whether it's fairly valued or not. So gold, I mean, you can hold it, you can fondle it, you can do all this, but you're not going to generate any cash from that, right? So,
Hmm.
but it has gone up. So I think that I understand why people own gold. I don't own gold. But if you own it just because it's gone up in the last 5, 10, 20, 30 years and you don't have a future forecast on it, I don't know. But I don't know. I don't know how to. My job is to discount free cash flows. Gold does not produce any free cash flow. It's a speculative asset. And I don't know how to value it, so I don't own it. But has it historically been a great diversifier? The answer is yes. Many smart people own it. The answer is yes. But that's not within my circle of competence, and I don't step outside of it.
Fair enough. Since Rudy, we have one more question from one of our participants. Coming back to the US, how are the current policies of Trump going to change the returns from US tech industries? Are they going to impact other industries as well? And are there any other countries that we should consider outside of US and India?
So the first point, the good thing about US is they've survived for 250 years, not because of the politicians, but despite them. You can't say that for a lot of countries that are emerging because you need to make the right strategic choices. Otherwise, you're toast. In the US, the capitalist system works like a dream, but you get extreme outcomes like you've got, right? So that's just an output, but because capitalism works, the rest of the US is not Trump or any all this nonsense. It's just if there's socialism coming there, then you have a problem. If you have social upheaval and the left come to power, that's really a negative sign. On your second question, if you look at this chart, I think the US is still the best market, but I don't look at countries because I think if I was to just summarize at a high level, the world outside the US and India is pretty screwed up. So US is like Europe is like a museum. China is a jail. Japan's like an old age home. And large tracts of Latin America are like banana republics because they just keep blowing up the currency. So the countries are all completely screwed up economically and financially. That's what I would say. And the data bears that out over 30 years. I showed you emerging markets. I showed you Europe and Japan. I showed you those charts. So I think what you need to do is buy the best companies that are in those countries that have nothing to do with those countries. So for example, ASML is a Dutch company. It's a European company, but 0.4% of their revenues comes from Netherlands, but they're considered a Dutch company. TSMC is a Taiwanese company, but very low percentage of their revenues comes from there. LVMH is a French company, 8% of their revenues comes from there. So basically, buy these companies that have nothing to do with those countries and you can do really well, or buy good growth stocks in India. That's the strategy. But if you just go by Japan as an index or Europe as an index or emerging markets as an index, you may make money with a trade, like from 8 times to 12 times, you make a 50% return, great. But after that, you can only compound at the rate of the earnings per share. And the earnings per share of of like emerging markets over the last 15 years has been 2% or 3%. So it's not a great return.
So, Rudy, you mentioned own growth stocks in India, but you yourself don't own a single stock from India in your portfolio. So, just curious to know why, and what factors would change that.
India is very expensive. There's a chart earlier that I showed where the P is the highest, and I don't think the earnings growth is great. I think people in India have got completely spoiled with the high returns over the last 5 years. I think the next 5 years need a lot of things need to go right to make the same returns as the last 5 years. So it's just a valuation call, I would say, but there's nothing that looks like deep down attractive to me in India.
One more question that we have from the participants is what should be the horizon for which we should hold these stocks? What is your view on the volatility of US stock market? In the last few months, we have seen a big rally and significant correction as well in the last 20 days.
I would say if you don't have at least a 3 to 5 year time horizon, you shouldn't be in the stock
Mm.
market. Second, if you look at your portfolio every day, you're not gonna become rich, and chances are that you'll feel very bad about yourself over long periods of time, right? Because the best way to make money is just buy it. Don't look at it for 5 years or 3 years. So that's what I would say. That that's why this fund has a lock in. We don't want people coming in with a bad experience. That's what I would say. Have that return expectation in mind, and you'll be fine. That's what I would say. That have that long term orientation. yes, you've seen volatility, but in 2022, the Nasdaq fell 32%. But then, it had a big rally. So volatility is par for the course. So that's why if you don't like roller coasters, you don't go to Disneyland, right? That's what I say. So there is a roller coaster, but you must have that 5-year orientation. So volatility can be your friend if you make money. But I would just advise your investors to temper their return expectations from these levels. Not to say don't buy, but just temper it. Right? The last 5-10 years have been exceptional. There's been corporate earnings per share growth and a huge re-rating that will not continue forever. So just keep that at the back of your mind. And you must have the mentality to say, I'm not going to look at my fact sheet like every month, every day, because the volatility will drive you mad, especially if you're not in financial markets. When the going is good, you'll feel great. When it starts to fall, you'll be like, what have I done? So I would just say that. Yep. So I'm happy to take questions if you have any for me. But if you're done with me, we can get into I'll probably sign off and leave it to Sudhir to take the hard questions.
Thank you so much for your time, and it's very early in the day for you. So thanks, Rudy, for spending the time here. And if anyone has any questions, maybe you'll just give me a minute. If
Sure.
anyone can post the questions or even raise your hand and ask before we move to questions on the fund for Sudhir.
So I would just say one thing, which is I've published over the last 6 months many monthly updates that will answer a lot of topical questions people have asked over the last 8 months. Some of which may be relevant today, some which may not be. So I'd request Sudhir after the call to send them to you, Raki, just to address some of those things. And those detailed notes will it's more like a Q&A. So I'm sure he can send that to you. And of course, if you have any questions anytime, if you email me, I can email you back my answers in case anyone hasn't got their question answered right now.
Perfect.
Sure.
Sounds good.
Yes.
Okay. Thank you,
Thank
Raki.
you.
Thank you
Thank
for
you, Rudy.
organizing this.
Thank you so
Wish
much.
you wish you guys all the
My
best.
pleasure.
Thank you.
So we still have Rudy on the sorry, we still have Sudhir on the call, and Sudhir can answer more questions about the fund.
Sure.
And I did see a few questions on fees, etc. So, Sudhir, a few questions for you. If you could tell us more about GIFT City and the opportunities it presents for investors, both in terms of outbound diversification for resident Indians and also inbound flows into India.
Yeah.
Um,
Thank you, Raki. I think good evening to you all. Yes, I think GIFT City is a new gateway of cross-border financial transactions with India. So we have utilized this opportunity to offer two different investment opportunities for both resident Indians as well as NRIs and non-resident investors. One is that, yes, we have already been discussing this ABSL Global Blue Chip Fund, which invests into the global market. Then we also have another opportunity to invest into ABSL India Flexi Cap funds into an India fund. So both investment opportunity, I think we have already seen in that earlier slides, and Rudy also touched upon that two best performing markets is the global market as well as an India market. So we have both these investment opportunities coming through an GIFT City route for easy investments from NRIs and foreign investors to explore both the markets. Yeah. So
Thanks.
it also provides a very tax efficient investment route for NRIs to access India, and as well as a much convenient route to invest into India through this GIFT City route.
If you can elaborate, Sudhir, a little bit more on the tax treatment, especially of this taxed, and the tax is different depending on your residency. So, what is the tax treatment for someone who's a foreign national or an NRI, and what is it for a resident Indian? If you can elaborate a bit on that.
Sure. So in a particularly in this global blue chip fund, if you are looking to invest, yes, the resident Indian will be taxed at the so it's a for the resident Indian share class at the fund level. We will be paying a tax at the rate of 12.5% because each of these investments will qualify for a long-term capital gains, and the tax rate is at the 12.5%. Would be deducted at the fund level. So whatever the returns which are the for recent redemption proceeds which investor will be receiving on hand is already a tax paid income, and hence they don't need to pay any further tax onto that. And whereas with respect to the NRIs and non-resident share class in the same fund, we will not be paying any tax or withholding or deducting any tax in India. The entire gains are passed back to the investors on maturity of the fund, and investors has to look at if they are liable to pay the tax in their home country, they would be paying that as per those tax laws. But if they're exempted, again, then it's completely an exempted income which they can enjoy in their home country or country of residence. So that is a one. With respect to that, another investment opportunity, what we spoke about, that India Flexi Cap Fund, it's open for only NRIs and foreign investors and foreign companies or foreign entities to invest. There, again, the same thing. There is no tax in India, no withholding, nothing, 0% tax. Entire gains are passed back to the investors, and investors have to look at whether they are taxable on the global income in their home, in their country of tax residence. If yes, they will be paying that. If no, then they will again continue to enjoy the tax exempted income.
Okay. So basically, for resident individuals, it is that equity long-term capital gains taxation, and for NRI, say based out of the Gulf or UAE, it would effectively be tax-free.
Absolutely right. Yes.
Yeah.
See, in either of the way, that is quite a very efficient tax returns for the investors.
Absolutely. I think, Sudhir, one more question which comes up is on inheritance taxation, especially because a lot of the global investments that happens in US, ETFs, etc., get subject to inheritance tax. So can you clarify how inheritance taxation or estate tax is handled for this fund?
See, this estate tax and inheritance tax is specific to the specific countries. In India, there is no inheritance tax. In India, there is no estate tax. Hence, all these funds would not be taxed in India either as an estate or an inheritance tax. The investors, basis the country where they're residing, they have to look at what is the kind of taxation which would be applicable. For example, if someone is living in US, if they are getting any investments inherited, I think something like this funds, if he is inheriting, there is no tax on the inheritance, but again, they have to pay the capital gains or other tax on the income tax, what they would be earning from these investments. Same thing, it is all country specific. Investor has to look at in his home country, what is the tax applicable on the inheritance of the estate. But at the fund level, at the India level, we are not going to be deducting or paying any tax towards the inheritance or estate.
So basically, for resident Indians, it would be treated like an India fund, and therefore inheritance tax does not apply.
Absolutely, yes.
I think there are questions on fees as well. So if you can clarify the management fees.
Yes, we do charge a certain fees here for the fund management. It is only a plain fund management fees which we are charging at this GIFT City fund level, and we don't charge anything else in other than this fund management. No performance fees, no hurdle rate, nothing. It's a plain vanilla 1.5% fund management fees, and as it AUM size or the investment amount goes up, that the expenses do comes down. So it's basis their investment amount, they can choose the expenses will be charged. And a very simple structure. So anything, whatever the returns which they're generated by the fund, it is all theirs, and no performance fee or any other sorts of fees is charged to the investor.
Thank you, Sudhir. I think that clarifies a lot, and we've come to the end of the session. So I think we've covered most of the questions. And if anyone has any final questions, you can just post the same. Otherwise, I think we're good to close. And thank you so much for your time. Thanks to Abhijit for organizing.
Yeah. Thank you all. Good evening. And once again, yeah, thank you, Rakhi, for arranging this call to share our understanding about this. We're happy to assist you and assist your investors further if they need any further inputs from our side. So, and have a great evening once again.
Thank you so much. Thank you, everyone, for joining.